The Q3 GDP numbers have come as a surprise. Multiple factors have contributed to it. One of the major reasons was the growth in net taxes.
The GDP number 43 at 8.4 is indeed promising. But if you look at the GBA numbers from the supply side, it is like largely in sync with what market was expecting. So this huge difference between GDP and GBA to the tune of 190 basis points, largely because of net taxes. Right. So net taxes is basically your indirect taxes minus subsidies. Net taxes grew by double digit around 32% in quarter 3, and that's largely because your expenditure on subsidies fell. So this is in part, your net taxes in part is sort of driving up the GDP figures. So if we look at the internals from the demand side, so heavy lifting is being done by government spending on capital. So capital investment, Capex, so that has been driving the GDP numbers.
The most significant driver of growth continues to be consistency in government Capex.
But disappointingly, private consumption expenditure remained subdued, which sort of shows like stress in the rural economy. So from the supply side, heavy lifting was done by manufacturing, and for quarter 3, that was in sync with high frequency indicators that we saw, like in addition to the base effect also playing out.
Will this growth momentum sustain? Strong rural performance coupled with government support of the sector could help in keeping the growth numbers upbeat.
For drags, I mean, agricultural growth was a drag. It just reflects your uneven monsoon and lower kharif production. For the entire year, the agency revised up the growth forecast to 7.6. So that implies like for your quarter 4 GDP number, the residual will be somewhere around closer to 6% or slightly below 6%. So that's the residual calculation. And going forward in FY25, we're expecting a growth of around 6.2 to 6.5%, which will be supported by Capex and some improvement in private consumption, which will be done by a catch-up in rural recovery. So we are expecting a catch-up in rural recovery owing to better rabi production and assuming a normal monsoon, some moderation in inflation, which will likely have an positive impact on the consumption bit, plus some welfare schemes that were being announced in the budget for rural sector. So all these factors bode well for rural consumption. So that's why we are expecting rural economy to catch up with the urban counterpart. But having said that, yes, Capex will continue to do the heavy lifting. So it'll be again like an investment-driven growth in FY25. In addition to, and there'll be some support from the consumption side as well.
While rural economy is expected to catch up with the urban counterpart, Capex is likely to continue to do the heavy lifting, and the growth plan for FY25 is likely to remain investment-driven.